All right, let's chat about call options and option trading. Specifically, when we think about growing our wealth, we think about different strategies. That's what we do here on the podcast, is talk about different strategies to add to your wealth creation and thinking about how you're going to get there, and then what are some of the best options. I think we always ask questions like that. Am I missing something, or am I not taking this road, or should I take this road? And we always wonder about the road not taken or the roads to take. One of the tools we've used along our pathway is option trading on the stock market. We also just released a number of episodes. If you want to go back in the history here, to some previous episodes about early retirement, and specifically talking about the math behind early retirement. We talk a lot about managing our portfolio in those 4 episodes around early retirement, specifically on the stock market and how to manage those your portfolio. And one of the tools that we've been using on our portfolio is option trading. And specifically in this episode, we want to talk about call options and give you some insights on whether you want to add this as a small strategy. And I think you might be surprised the way we are going to talk about call options and the way that other people talk about call options. Because like Kyle, people are like, oh, those are the risky things. Call options, that's the most risky you can get. And you know what? You can be right, but there are 2 sides to options. So let's get into what options are and how do we want to think about them. And then eventually let's talk about the tax implications of, owning or holding or writing call options and then taking premium on them, because that's specifically what we're going to kind of chat about here.
Yeah, for sure. So today we're going to focus, like you said, we're going to focus on one type of option. There are 2 types, there are puts and calls. But today we're going to talk about, and this is sort of like, why we're starting with call options and why we're starting with what we call covered call options is because this is the easiest place to start. And it's also really safe. It's safe enough that actually in your registered accounts, you can actually use this strategy. Whereas sometimes registered accounts actually have restrictions on what you can do in those accounts. So a call option, and specifically when we sell a covered call. Okay, this is the important piece. We're not buying calls here. We are actually the sellers of these calls. What you're doing is you're essentially giving someone the option to take your stock at a specific price over a specific duration of time. So for our real estate friends, everybody knows, when we got into options, what really resonated with me was it was like a way that I could rent out my shares, my stock. And ultimately at the end of the day, it kind of like a covered call kind of is like a bit of a rent to own strategy, right? Where you buy a home, you give someone the opportunity to rent this home, and they also have the option to buy the home from you for a specific price after a specific period of time. So
it's
if
like a contract you've written up, and that's right. So
exactly.
It's like you're locked into this. If I buy this house and I'm going to sell you this house down the road in a future period of time for this exact price, and we both agree that no matter what happens, that's what we're going to do. And you have the right to exercise that option when the time comes. And that's, I think, maybe the slight nuance we want to add here in the rent to own kind of analogy is that, say the time comes down the road, like 2 years down the road, if that's when our contract expires on our rent to own and on my home here, when that gets there, our renter who's been paying us rent all this time, they get there and they're like, you know what? I don't want to buy this home yet.
Changed my mind.
Let's just let the contract expire. And we're like, all right, that's fine. We will keep owning this house. And then we can go to someone else and rent it to that person over there for a new price and a new date down the road. But let's say we get to that spot down the road and the renter's like, hey, I looked at the prices of homes right now, and this home is a lot more. Yeah, this home is way higher than what I agreed to buy it at. So I'm going to exercise my option. I'm going to hold this contract true. John and Kyle, I'm buying this house for you at this the agreed upon value we decided years ago, and then we have to then honor that contract and sell the house to them at that, even though we're like, the house prices are up. So we have to stick to that as homeowners. The same scenario is exactly what happens when you sell a covered call option on, say, shares you own of a particular equity.
Yeah, I love it. I love it. It's a great analogy. The same is true for like a lease. Like a dealership is essentially giving you the option.
Right.
You're going to rent this car from me for X number of months,
True.
years, whatever. And then at the end, you could buy this car for this price. And actually, the way it worked out during COVID for me, I had a lease. It was a really cheap lease. And it came to the time where my lease was up and I looked around and I was like, this same truck is worth $15,000 more than what I will pay to buy this thing out. So I bought it. I exercised this option. So the same is happening here with stocks. And when we sell a covered call, why they call it that, they say it's a covered call, is because really there's no risk for you in terms of losing anything except for potential upside. Like you said, there is some potential upside because like if that stock goes to the moon, then guess what? If you agreed to sell it for X and it's now worth X plus 100, well, guess what? You agreed to sell that covered call, which meant you were renting the shares and you basically gave them the right to take those shares from you over the next 3 weeks. It could be 3 months. It could be 5 years. It could be whatever you want. You can sell this covered call. And of course, if you get to the place where the covered call is expiring, this could be a week from now, a month from now, a year from now.
You said that.
Right? You get to decide, right, what option you want to sell and at what price. And then basically it goes to the market and the market tells you like, yeah, that's worth it to me or it's not. And what you're actually earning off of this covered call is what we call premium. Now, for those who have listened to the podcast, we love all kinds of insurance strategies. This option strategy, it's like insurance. You're basically selling to someone, you're selling them for a premium, the opportunity for them to take the shares from you. Now, let's think of it from the other side though. Like the person who's buying this option, they have to, if they're buying a call, they're basically thinking that over a specific period of time that this stock is going to rise in value, right? Because the cost of this option, if they wanted to sell it back to the market, is going to go up in value. And it's what they call like a leveraged bet for the buyer. But we're going to be the sellers. So we're going to be the insurance company. Okay. And I'm happy to say it. Like, I'm a safe guy, right? So it's like, I want to be the guy that is here going, listen, I've got this stock and you can do this on ETFs, for example. That's what we tend to do. We used to do it on stocks. And guess what? We did all kinds of other calls, our option strategies. We'll get into that on a future episode. But now we're more or less looking at this and saying, you know what? If we could get a certain amount of return on the stock that we're holding, if we can like make that premium, I actually don't really care a whole lot about what the stock does, right? Like if it goes up, I'm not like heartbroken that I have to give it away because guess what? Usually stocks come back down again and then there's an opportunity to buy again. You might have to buy in higher again. But if I'm going to use this covered call strategy, I'm not too concerned about that because then I'll just go ahead and continue to rent out these shares. Like ultimately at the end of the day, we're more interested in the premium, in the amount we can rent this for than its value. And I want you to pause for a second, especially our real estate friends. The same is true when it comes to when you buy real estate. Although you like it when the property value goes up. That's like a bonus usually, right? We're actually doing this for the cash flow. You're doing this because you want someone to pay you each and every month for the ability to help you pay off a mortgage and of course, put some cash flow in your pocket. And the same is true here where we're going, hey, the stock's sitting here. I might as well rent it out and I get to decide what that rent is worth to me. And at what price I'm okay with someone else taking those shares from me.
For sure. So it's like you already decided that those shares were something to own. Like you're not running out here and buying shares, just that you don't care about, or you're playing, I'm going to use air quotes here, playing the market. And these are you want to think of this as like, I already have decided that these shares in this equity are worth it, and they're sitting there, and you're like, it's part of your portfolio. They're going to go up over time. And you're probably betting on the length of the time in the market. It's like I buy shares on a regular basis, or I've invested on a regular basis, and in 20 years, my portfolio is going to be worth blank. While they're sitting there, you could also be earning and do some calculations on earning that premium, which goes into your portfolio. Like it's money that goes back into your portfolio for you to buy more shares, and use that as part of your strategies. Like for us, for a while, we were like, what? And this is some of the goals in the systematic work that we were doing with this particular strategy, is saying, what type of return do we want on our capital here? And can we get that with this option, the selling covered call strategy? And I remember at the time, Kyle, we were like, we would love to have 1% per month, which is 12% over the course of a year, right? So it's like, if I could, and that's not even accounting for compounding during that time. So it's like, if I could get 1% during this month, we were doing, monthly covered call options. So it's like, in a month, I'm going to set an expiration date for 1 month, and I'm going to look to see if I can get premium that is about 1% of my share value. And if I'm okay with that, then I'm going to sell that covered call option, and someone might pick me up on that. And then if the price goes up during that time, I lose, like my shares are taken away from me if they exercise the call, but I got 1% on my money that month, which is like, sounds pretty great if I can do that month to month.
And if you sold above the price, if let's say it went up $1, right, you actually made money there too, because you sold it for a higher price than what it was worth at the time when you sold the option. So you get to keep the premium, and then they take your stock, they pay you the price they said they'd pay you. And now you have one of two options you could do. You could just sit on the sidelines and wait for the stock to maybe pull back down, put it into something else, or you could buy right back in and go, I'm selling the next covered call on this thing.
Right. Yeah, like you already have these shares, and it's so. I remember hearing a recommendation from another trusted person who does this, basically saying, if you have 100 shares, so that's the caveat here. You can sell calls if you have 100 shares of say a stock, and say, if you have 100 shares sitting in your portfolio and you are not selling covered calls, you are missing the boat. Like you're missing some income that can come into your portfolio, and that's what we were doing. We were doing that for a long time. It's still part of our strategy to move forward on using option strategy. So now let's flip to the other side. Like you did bring up buying calls, and when you hear most people talk about call options, they're probably talking about buying calls, which is like, in a way, you're hinting that this is the risky
if I say
side of
GameStop and options, we're talking about buying calls.
People are running on, I think, people are running on the fact that I'm like, I don't have to buy 100 shares, or I don't have to buy the full price of a share to get part of that action, right? So they're buying the premium. So it's like when you buy a covered call, you're saying, like what you said, Kyle, I think the value is going to go up. Therefore, I'm going to buy the covered call, which means you pay up front the premium. That premium immediately goes to the seller of that covered call. And so, the premium is not the price of the stock, right? The premium is like the rent. And so a lot of times you're paying a lot less money to get involved and get into the movement of that stock. And so what happens, though, is that if it goes up, you make a lot of money on, say, that investment on that stock, depending on the covered call, because you're going to sell, you're going to exercise your options, or you can cash out that option at the time. And this is how people are trying to make a lot of money selling buying covered calls, or buying calls. So there's like that side, but that's the risky side, because I think, what's the stat, Kyle, on like options expiring worthless? So it's like high, right? It's like you're betting on this thing. It's like a lottery in a way. It's like because if it goes down past your strike price, you're not going to exercise your option. Like if I'm the buyer, I'm going to be like, why would I exercise this? I'm going to get these shares less than what I paid for, and then I have to pay the full price of it. Right. So it's like, I don't want to do that, so I just let it expire.
I would love it if someone did that.
For sure.
You know,
If
they
you're
were
a
like,
seller,
I
if you're the
want
seller.
to buy this for $1 more
Yeah.
than what I can buy it for on the stock market right now. Like, so
Yeah.
it's just not going to happen. Right.
So a lot of these expire worthless, and that's the risk people take. Is like, I have to pay the premium up front, which isn't the full price of the share, but it could expire worthless. Like if the stock goes down, I just paid money and I don't get anything out of it.
Right.
And so that's why the selling side actually is in your favor if you already own the shares and you're okay with limiting your upside potential. So if you're just strategizing around this is why we were like, okay with, if I can earn 1% per month on this money that's valued here in the stock, it will be a winner for us. And that was the way we defined that part of our portfolio. If that's not okay with you and you're just hoping, for more than 12% or more than whatever this agreed upon value that you want to strategize around, then you might want to just set this ride and go, because that's what you have to decide to do. So we wanted to bring that up to see, like, we're talking about selling covered calls, not buying calls here in this particular strategy for our income. Now, if I'm selling covered calls and I take in the premium, then as soon as that contract is, say, set, so someone takes that contract up with you, you get the premium in your account immediately. Like it's there, boom. Like you've got cash now sitting in your bank account, your trading account. And what that is, though, is income, right? Like you're taking that as income. And then what we want to think about is, okay, let's say you do that on a regular basis, or you do that monthly, or whatever you do. Maybe you don't do it regularly, but you do it sometimes, and you're taking that income from the premium. What are we going to do at tax time? Like, how is that treated? Like, let's talk about that, Kyle, because if I do make this part of my portfolio, I do have shares sitting in my registered accounts or my non-registered accounts, and I sell covered calls on them, and I do say make 12%. How do I treat that 12%? How does the CRA treat that 12%? Is that something that I need to consider? Because that's what we want to. That's what we always talk about here. Is let's grow the pile, but let's protect the pile based off taxes as well.
Yeah, 100%. Yeah. So like if we talk from a taxation perspective, and we think about, let's say, registered accounts where, there is no tax, like you don't have to worry about tax there. RSP, tax-free savings.
Well, deferring RSPs.
Yeah, exactly. You're going to pay on the way out for your RSP, but I could do this covered call strategy routinely and not have to worry about paying anything in this particular tax year unless I take some money out. So it's actually a really nice income strategy. Now, if it is in an unregistered account, or if it is in like a corporate account, because there's a lot of our friends that listen to this podcast, we talk a lot about those who are incorporated, and they might have trading accounts. And oftentimes what you'll do in unregistered accounts in many cases is we go, listen, you want to buy like capital gain assets. Like you want to buy, things that are going to appreciate in value, because the tax burden is going to be less than, say, taking it as income, right? Like dividends are going to be taxed as income. And, one thing that we can think about is that typically, now here's the tough part, is that, there is some nuance to it, but typically the options premium is considered capital gain typically. Now, when we talk about our business owner friends, you've got sort of like 3 buckets to worry about. Like on a personal side, it's like, is it income or is it a capital gain? Those are the 2 sort of buckets you're looking at. Capital gain is better than taking it as income unless you're in a really, really low tax bracket, and then taking it as income wouldn't be as much of a bother. But if you are in a higher tax bracket, or if you are doing this inside of a trading account inside your corporation, thinking about, is this like passive income? Is it active income? Some want to argue that it's active income because you're actively trading. And if you're considered an active trader, then potentially it could be considered active income. However, from all the research we've done and all of the digging we've done, typically what we see people claiming it is as a capital gain. So this is something that's important to note, is like if I buy an ETF and I just hold it for 20 years, I'm not going to trigger any capital gains at all over those 20 years, which is good. Like that's a good thing. But the part that you miss out on along that trip is opportunities to sell when maybe the market is really hot and buy when maybe the market has cooled off a little bit, right? So doing a little bit of buying and selling along the way. This option strategy can kind of almost force it on you in a way, right? Like if someone takes your shares, they are making you sell your shares, right? So you will trigger a capital gain on those on that gain that you've had, depending on when you bought the stock and how much it's grown by. And it's likely that those option premiums are going to be considered capital gains as well, which essentially is not nearly as bad as considering it as passive income inside the corporate structure. So there is some positive to that strategy, even if you're doing this inside of your corporate trading account.
So I was just had this picture of, like when you think about if you're thinking about swing trading and trading and going, like forcing you to sell those shares along the way is like forcing you to take those profits when you can. So setting your strike price at, say, some of these upper levels in the ranges of where you think this price might be a nice strategy for you to be like forced you to sell some of those shares at that price, and therefore wait for them to come back down, buy low and sell high. You know how this game sometimes works. Now, the downside here, Kyle, another downside is that if you are I guess, set it and forget it type investor right now, and be like, I just dump money in the S&P 500 index, and it's my plan, that's my strategy, then this is a little bit more active for you. If you're going to be selling, let's say, monthly covered calls, you're going to be wanting to be active here on a somewhat regular basis to kind of manage and track a little bit. Now, it's not overly intensive. We've done this. It's not like, hey, I need to be on this either every single day or every multiple times a day. This is not the scenario, which is a nice addition to a person whose portfolio is a set it and forget it, is to like, look, a few times, maybe once a week even, I could be just monitoring and having a look to see if my covered call has been, gone away, or I could, I can cash that out. Because there's nothing saying that you also don't have to, wait for that call to expire. You can end that contract yourself midway through. And also kind of move on. So there's some nice strategies around that, but the cover out of all of the, in a way, the 4 different call or the option strategies between calls and puts, selling and buying. I like the covered call strategy as a nice safe addition to an already existing, set and forget it portfolio.
100%. And, there's some things we will be talking in some future episodes about, some ways we can layer on some other strategies as well. But keeping in mind, the one, I think, caveat to any of this, as we go down the rabbit hole and as we learn more, I know I'm this person where it's like I learn something new and then I'm like, oh, I really like that. I want to learn everything about it. And then you learn that there's like a way you can maybe do this even better. and you could go way down this rabbit hole. But like you had said, though, one of the biggest parts, and it's probably the hardest parts too, is like whenever you're going to take on a strategy is trying to really get comfortable with what your goal is. And I still struggle to this, every day. When I see a stock go through they call it the strike price on a covered call, and let's say it takes a sharp rip, which actually happened yesterday. I've got a bunch of Bitcoin ETFs, inside some of my trading accounts. So I've got it. I hold it, and we've been floating around at like mid 90,000s. And, I had some covered calls on these shares. I'm a big fan of just premium is really all I need. And the day before I would tell you all I care about is the premium. Guess what? Yesterday, kind of cared about that upside, a little bit. Like I was like, oh man, shoot, if I waited to sell that covered call until yesterday when it bumped up above 100,000 and then I sell the covered call, I could like sell it at that strike price. By today, that call option would be worth a whole lot less because Bitcoin now went back down to like mid 90s again. So it was like a 1-day bump. And it's like, but again, you can't get mad at yourself for that, because like, how would I ever know that's going to happen? Guess what? I'm still going to earn the premium that I agreed to take. And they can still take those shares. And if it expired yesterday, they would have likely had taken my shares away for what, the 95,000 or whatever it's worth. And, they would have gotten it at that steep discount because of that call option. Here's the crazy part. I still hold that call option today. That person that bought it from me bought it from me, I sold it to them. They had an opportunity, but because it wasn't expiring, no one's going to exercise it early. So they just let it ride. And guess what? Now we're back to where we were 2 days ago. And here's something else that's happening in the background, which is a little more nuance to it. But over time, every day that I have this call option out there to the world, that person is holding it. It's like a hot potato for them. They hold the hot potato because the value of that thing, if let's say the stock price stays exactly the same from now till expiry, every day, the value of that call option keeps decaying. They call it decay because basically it's basically saying that there's less and less chance that this particular call option is going to turn into something that's actually profitable. So he might have sold it, or I should say, I may have sold it for $100. And that person is holding this hot potato that he bought for $100. And if the strike, if the stock value goes up, that 100 is going to turn into a greater number. It's going to go up with the stock price, which is what they want. What I want is really just for that hot potato to be worth less and less each and every day. So if that stock price stays exactly the same, or if it goes down sharply, the price of that hot potato goes way down. And I have the opportunity to buy it back. I don't have to buy that one back from him either. I get to buy anyone who's willing to sell me their hot potato because they no longer want it. So I could have sold it for $100, and a day later, it might be worth $60 now. So I don't have to hold this thing, or I don't have to have this contract out until expiry. I might decide, you know what, $40 profit in a day or two or whatever it was, that's worth it to me. And like you had said, if you set certain targets, for us, it's 1% per month, which is actually fairly easy to achieve just in premium, which puts us at about 12% per year without considering any of the upside we might get even on stock that's called away from us. We look at that and say, you know what? I like that. I like that as the opportunity that we're willing to earn some income, because guess what? If the market takes a dump and all of a sudden it goes all the way down and it takes a 10, 20% dump, guess what? That hot potato is going to be worth close to nothing. And at least I got something while the market was at that place. Now I'm stuck and I may not want to sell covered calls while the market's down because I don't want to give up my shares at a loss or anything like that. But ultimately, I was able to make something even though the market was maybe not working in our favor.
Mm-hmm. The secret sauce here for us is basically thinking about some of the options. See what I did there? The options.
I like that.
Some of the options we have when you're trying to create more of our pile, more of our portfolio, and more knowledge is better than less knowledge. You want to know what's available to you, and then what you want to do is assess, whether that strategy or whether that, that move is a good addition to what you want based off the lifestyle you want to achieve and lifestyle you want to live now. Like if being active here is not for you, then this isn't for you, but at least you knew about it. And we've just kind of briefly touched on this. So you're going to want to kind of take deeper dives into options trading. You can check out our book list on our website, CanadianWealthSecrets.com/books. We've got a number of books there that we've been, we've read, we've used, we put into action. Check that out for a deeper dive into options trading. that would be a great next move if we've kind of sparked an interest here for you. But the secret sauce for us is if we have our portfolios there in either of our registered accounts or our unregistered accounts or even our business trading accounts, and we're not using this particular strategy, and then you might be missing out a little bit, because it's not that big of a stretch to add this to your already existing kind of moves for your portfolio growth.
Yeah. And for those people who are doing most of their investing with, say, the big bank or whatever, your typical platform, sometimes they're not as easy to get started with options trading. So first off, I would recommend that you don't do any options trading until you have a lot of practice. Paper trading accounts are very helpful. But also, you might consider looking at some of the different brokerages out there that tend to be a little bit more friendly on that front. One that we use is Interactive Brokers. It's very cheap as well. So buying and selling stock is very cheap. They have great exchange rates. If you're going to be buying US equities and such, you can head to CanadianWealthSecrets.com/interactive if you'd like to take care of their bonus. Note, full disclosure, we'll receive a little bit of a friend or referral bonus from that link as well. But if you want to start with some money in your account, that's one way to do it. And, but there's some other great ones out there. Think or Swim, I think, is another great one. And there's a bunch of others that might be worth exploring. However, we've always stuck with Interactive Brokers as the tool that we use for our accounts. So once again, CanadianWealthSecrets.com/interactive if you want to check them out.